Hello, everyone, and welcome. Good morning or good afternoon, depending on where you are in the country. Welcome to LendSure's non-QM loan solutions for e-paper borrowers webinar. Today's agenda. Today we're going to be talking to you a little bit about LendSure Mortgage Corp. We're going to be talking about the non-QM market and the opportunities there. And then we're going to be presenting real-world solutions or real-world scenarios, rather, on actual loans that fall into non-QM category. And then we're going to have a question and answer. Please go ahead and use the chat function to type in any questions that you have throughout the presentation, and at the end, we're going to address as many of those as possible. If we don't get to your questions, no worries. We have everything logged, and we will get back to you with the answers after the webinar. After the webinar, there's also going to be a brief survey. Please take a moment to answer a couple of questions and let us know what you think, and it'll give us ideas on future topics that we can present to you. Now I'd like to present our speaker. It is Joe Leiden, the co-founder and managing director of LendSure Mortgage Corp. Take it away, Joe.
Thank you, Rose. I appreciate it. Just flip to the next slide there. So this is just a little slide that describes who we are. I'm not going to read bullet point to bullet point. It's pretty self-explanatory. Suffice it to say is that the management team here at LendSure is the same management team that managed accredited home lenders. It was a publicly traded non-prime mortgage company back in the day. That company was successfully sold in late 2007 to a private equity firm in Dallas, Texas. Rose, the next slide. Rose, the next, there you go. So what we do, I generally like to start out when talking to brokers with what we don't do. We do not do any Fannie Mae loans, Freddie Mac loans, FHA, or VA loans. Our principal focus is on targeting A-paper borrowers who are just missing Fannie and Freddie guidelines for one reason or another. During this presentation, I'm going to describe some of our programs, and I'm also going to give you some examples of the borrowers who we serve. Next slide. The why non-QM, again, there's 5 bullet points there. I'm not going to read all of those, but in my mind, why non-QM today? Why should you be thinking of non-QM? I think principally interest rates are on the rise. I think everybody in America think they're going to continue to go up. And that's going to mean less rate term refis for most of the A-paper loan officers in America. Those loan officers, if they want to earn the same money this year that they made last, are going to need to look more closely at the borrowers who are just missing Fannie's guidelines. We would propose that you people have been seeing these loans for years, these borrowers yet, but have been passing on them because they don't fit, either Fannie's or Freddie's AU engine, and you pass. I think there's opportunities there. There's lots of reports now in the newspapers and in the industry rags that say that the non-QM segment of the market, mortgage market, is going to go up this year by 2, 3, 4-fold. And we're beginning to see that because we're getting lots of calls from brokers and bankers in the space asking for our loan or our AEs to come for a visit and describe our products. Next slide. So this slide really puts on display basically a snapshot of our portfolio. In November of 17, we securitized the first segment of business that we produced. There's a $141 million securitization that we did. It's actually an Ellington financial securitization, but all of the loans embedded in that securitization were loans produced by us. The stats you can see, it's a 708 average FICO score with a 65 loan to value. 57% of these loans were to people who needed to use bank statement to qualify their income. 53% of the loans were purchase money loans. 78%, that's a typo, were owner occupied, and 19% of them were investor. I think you'd agree with me that that's a pretty clean book of business. It's not your standard non-prime book of business. We're trying to put on display that these borrowers are, in fact, very much A-paper look-alike loans, with the exception, of course, is the bank statements. We're going to talk further a little bit downstream about other areas in which we do loans that are just missing Fannie and Freddie's guidelines. Next slide. So what makes LendSure different? I think principally we use a pre-underwriting process that provides the broker with a pre-approval and pricing on their scenario. That enables them to pitch the product and pricing to their borrower. All of this happens usually within 24 hours. That's to say, if a broker presents us with a 1003 and a bureau, and he presents us with the bank statements, we can do a fairly thorough analysis on the transaction and then have a conversation with the broker and say, look, this is what this loan looks like. It looks like it's going to fit into our Alt-A product mix. The pricing based on the LTV and the FICO of the borrower is going to be in the 5.25 range. Then it then enables the broker or the loan officer to go back to their customer and actually pitch the product with confidence that, hey, this is the loan that I think we can get done at this rate. This isn't a full underwrite, but they've done a fairly thorough review of it already, and here's the price, and looking for the borrower's feedback. Is the borrower okay with the 5.25? If yes, we go forward. If no, the loan officer goes elsewhere, or he doesn't get a loan. So we provide that to the brokers as a feature of LendSure. We've got a great bank statement program, in my opinion. In a few minutes, I'm going to talk about that and why it's a great bank statement program. We're not an in-the-box lender. We have the ability to make exceptions, and we think of ourselves as being a common sense lender oriented towards A-paper and A-paper fallout borrowers. We're very, very much tuned into high-quality service levels. That's why we offer up the pre-underwriting process that I mentioned a moment ago. Next slide. So this slide is fairly straightforward. You know, we allow for the higher debt ratios. We do allow for some mortgage delinquencies. Non-warrantables, condos are acceptable, multiple sources of income. Most of these loans are just missing Fannie and Freddie for one reason or another. Next slide. I said I'd talk to you about our bank statement program. As I mentioned earlier, the pre-underwriting of the bank statements without a full package submission is, we think, significant, because most brokers whom we talk to really don't understand how to deal with the bank statement program. Most brokers are used to dealing with an AU engine and you know, Fannie or Freddie's AU engine that says, here's your approval, and provide these 30 steps and we'll get the loan done for you. Well, we don't have that. And so the brokers wonder, well, how does your bank statement work? And what am I supposed to do with these? How am I supposed to analyze these things? So it's a bit of a mystery to most brokers. So we say, we reach out to the broker and say, well, let us do it for you. Get us a 1003, get us a credit bureau, get us the story, if you will, and get us the bank statements. And within a 24-hour period, we'll do the analysis and come back to that broker. So we think we're the only ones in the industry that does that, and we do it for the broker. We don't ask for a P&L on any of our bank statement loans. We allow for multiple bank statements to be used, and 12 and 24 month programs are available using both business bank statements and personal bank statements, unique. There is no one-size-fits-all expense ratio to get to an income number. So we look at every transaction unto itself. We know that there are some business people who have very, very low expense structures, and then there are others who have very high expense structures. So we try to use common sense, and we've got a little questionnaire that we send to the broker, and we say, will you pass this to the borrower and get these questions answered so that we can properly evaluate the bank statements. That, you know, just to give you some examples, you might have a graphic designer who works at home. He's sits behind a computer all day long. He has no employees. He has no cost of goods sold. He's got no expense outside of the home. You'd expect that his expense structure is pretty much zero. And we're going to probably use zero if they're personal bank statements. And if not personal bank statements, we'll use a 10% expense factor for a guy like that. Then on the other end, you might have a guy that's, running a manufacturing business in which it's more likely that he's got a 90% expense structure because he's got a lot of labor and he's got a lot of cost of goods sold and raw materials and large staff. And so that one's probably more aptly 90%. But the reality of the day is every business is very different. So we use expense ratios that are all over the board, anywhere from 0 to 90, 95%. That enables us to do a lot of loans that some of our competitors will not do because our competitors have hard and fast rules that say, hey, it's 50% and let's not talk about it any further. We think that's a very big plus in our favor. Lastly, the borrower does not have to own 100% of the business in order for us to do the transaction. A lot of our competitors say the borrower's got to own 100%. We don't have that rule. If they own 75% of it, we're going to do the analysis and then use 75% of the income that we see from the business. And then finally, we look at NSF activity and we try to look at it from a reasonability point of view. So we have no hard, fast rule that says if you have 4 NSF checks in the last 12 months, you're turned down. We look at really the volume of activity in the account, and if you have a high volume activity, we're certainly willing to consider more than 4 or 5 or 6 NSFs. So it really has to do with the deal itself, but suffice it to say, we don't have any hard and fast rules regarding how many NSFs we will or won't use. That's the bank statement program. That's what we think. We think we've got a very, very good bank statement program. We think the fact that we're willing to deal with a broker up front with it really kind of settles the broker in on this is the deal that we can get done. And then they're able to confer with their borrower, able to pitch the borrower with the product and the pricing, and from there we go. Next slide. So here's some examples. I'm just going to, the next few minutes, I'll just talk about half a dozen examples of loans that we do. And these are real loans. Of course, I'm not giving you the real names, but this is the borrower's first example. The borrower, we made a loan to a dentist. He's 20 years dentist in the Bay Area, the San Francisco Bay Area. It was a purchase money loan. The guy needed $3 million on a $4.5 million purchase price. So he's putting 35% cash down. About 40% of the cash down was gift. Guy had an 810 FICO. So I think you'd all agree that that's a pretty righteous borrower, and that looks pretty A paper to me. So why did it go to LendSure? So on this one, we needed to use business bank statements. And we did, and they were very consistent and very strong, with no NSF activities. We were able to do the loan. We approved the loan, and literally 2 weeks later, we're closing the loan with a 5 3/8 rate. Next slide. This transaction was a full doc loan. The purchase money loan up in Los Angeles, the Glendale area. It was $1 million loan amount, 90% loan to value, 10% cash down, 775 FICO, and a DTI of 48%. So you can see, again, you've got a very strong borrower there. You've got full doc income, very good FICO. The DTI is a little high, and it's certainly a jumbo loan amount, right? $1 million loan amount. So why did we do it? LendSure, the loan amount, we were able to get the deal done at 5.5%, close the loan. Next slide. This one was a $1.2 million purchase price at 80% LTVs with a 960 loan amount, 740 FICO, full doc transaction. Again, I think you'd agree, pretty righteous borrower. Looks a lot like an A-paper borrower. So why did LendSure do it? It's a non-warrantable condo. So just several examples that we're trying to show you that these are borrowers that I think, A-paper brokers and loan officers see these types of borrowers every day. And because they've been so busy with what I call the low-hanging fruit of the easy refis that, have been there for them over the last 5-8 years. With those easy refis going away, these, I think loan officers, might be willing to take a little closer look at deals that they weren't able to get done. So that's why we're putting these on display. So next slide. So here's a guy that needed $500,000 in cash. Again, San Francisco Bay Area. The loan amount was $1.5 million, 765 FICO. This one's, again, full doc. The guy owned a restaurant chain in the Bay Area. The loan to value was 60%. Actually, it was more closer to 55, I think is what it was. He had good assets for reserve. So, he literally was approved at an A-paper lender. And then, why LendSure? The appraisal came in, and the guy owned a 2-unit home about a block away from Dolores Park, very good area of San Francisco. And he converted it into a 1-unit. He was using it as a 1-unit for his family to live in. So it was an owner-occupied 1-unit. But the appraiser said, and rightfully, it's a 2-unit, and it's been converted, and it's going to cost you $50,000 or $75,000 to convert it. So that was problematic for the A-paper lender. Broker brought it to us, sent us the appraisal up front, described the deal, and within a few hours we were able to say, yeah, we'll do the deal. It's our kind of deal. We did the loan at 5.5%. I think again you'll see that it's a very righteous borrower, very A-paper oriented, and we were able to do the loan. So this is probably the lion's share of the kind of business that we do. We do some business that is more, tougher delinquency, borrowers who are having trouble paying their debts. We think our real niche, though, is in the upper grade products, the Alt-A arena. So that's what we're spending our time today doing, is talking about these products. But we are fairly common sense type lenders. If things make sense, we're always willing to talk through scenarios with brokers and try to get to an end point where we say, yeah, okay, this is a loan that we can do. We don't try not to waste the broker's time. We know they're busy. Next slide. Here's a guy. Here's the one with a little bit of hiccup to it. This guy actually was a woman in her house for 25 years, and she had excellent credit. Very good credit. 690 FICO. And the issue, though, was her HELOC. As most of you know, most HELOCs have a 10-year balloon on them. And this borrower specifically, had the first mortgage had been open for 15 years, and her second was open for a little over 10 years. Both paid perfectly throughout that whole time. The rest of her credit file is perfect. But the lady got to the end of that balloon period, and she went into the bank and said, hey, it's time to renew my loan and recast it. And they said, no, we don't do those loans anymore. And so she basically got into a pissing match with the bank and wanted to fight with them over it. And essentially 3 or 4 months later, she realized she was going to lose the fight. The bank won the fight. And then she was in a pickle because she was fighting with the bank, she basically harmed her own credit. So she's no longer capable of going out and getting a renewal with an A-paper lender. So it lands on our desk, and we look at it and we say, come on, the lady's been perfect for all these years. This makes sense all day long. So why LendSure? Well, clearly it was the HELOC issue, right? We were just using some make sense lending, and we're able to do the deal at 6.5%. Next slide, please. So this is a deal. The purchase price was $1.2 million, 20% cash down. Credit was very good, except for a 1x30 late in the last 12 months on an investment property. So it was full doc. We got a solid letter of explanation on the 1x30, one that was believable because the rest of the credit file was excellent. The FICO was still 740, and the DTI was 45. So the DTI was a little high, but we look at it and we say the borrower is really pretty darn good, but obviously the 1x30 on investment property is not going to get done in the A-paper world. So why'd LendSure do it? The 1x30 is the last 12 months. That's why we're getting it. We were able to do the deal at 575 rate. So, really the goal of going through some of these scenarios to give you a sense for the loans that we do, and the fact that Many of the loans that we do look exactly, these are real loans, so they are a paper type of borrowers who are just missing for one reason or another. Next slide. More examples. Okay, here's a doctor. Oh, this is one that's actually kind of in the hunt. We haven't quite closed this yet, but it's supposed to close this month. But it's a $1.8 million loan amount. Woman's a doctor for Kaiser. She lives in a $2.8 million house in Del Mar. She got a 722 FICO. Her credit is generally very good. It's 64 LTV, and she needs to pay off a first, second, and she doesn't have a tax lien against her, but she does have about $150,000 in unpaid income taxes. So why are we getting this woman? Because we're allowing for the use of K1s in lieu of full doc 1040s. So, generally, the woman's writing off a lot on her 1040s, and we say, the lady's a doctor going from one hospital to the next. She doesn't really have a lot of expenses. So we got the approval to do, the underwriters say, okay, I'm willing to use the K1s. And we did a loan. The ladies owned the house for a long time, and it's a beautiful home in Del Mar, and we just think it makes sense. And by the way, the loan saves her about $1,000 a month in monthly payments. So loan made sense. We were able to get the deal done, and we did it. And I think that one was priced at 5.25 and a point or something. Some points were used to buy down the rate. Next slide. Roses, are you there? So anyway, so that's the end of the examples. I think you've seen enough of those. But here are the programs that we do. I'm not going to get into detail. We have a subprime Alt-A. A lot of the loans that you just looked at fell into the subprime Alt-A category. A couple of those loans fell into the expanded approval, the one with the HELOC issue, and then we have an expanded investor product. The expanded investor product is basically some people call it the DSCR program. It's where we don't require income documentation on an investment property. We're basically using the cash flow of the property to qualify the deal. And so we're starting to see a lot of this business. This product is really designed for experienced investors who have a lot of properties who are able to do these kinds of loans without going full doc, essentially. And then finally, we have a foreign national program. We're starting to do a lot of those loans as well. As I said, I don't want to get it down into the granular nature of each of those products, but we've got a fairly full menu of products for borrowers who are just missing Fannie and Freddie. We are very comfortable with the product line. The loans are performing. They're performing beautifully. At the end of the day, we make loans to people who we believe can pay us back, and we use common sense along the way. Next slide. And so at this point, I guess I'd open it up for questions and answers. If anybody has some questions, I'll let Rose kind of direct this process.
Thank you, Joe. So we've gotten some questions that were submitted at registration. And for everyone else, please use the chat function. I'll be taking a look at it, and we will answer as many questions as we can. We don't want to go too over. But someone from Finance of America asked, do non-QM loans have higher interest rates than conventional loans? If so, how can the loan be structured to buy the rate down?
So buy downs, we allow for a buy down of up to 100 basis points. So if the base rate is 575 and you want to get the rate down to 475, we'll allow for that. And that cost is 2 points. It's basically 250 for one. So you buy down a point, the borrower's got to pay 2 points. With us, we're a little unique when compared to our competitors, because we allow for the buy down points to be stacked on top of the LTV. Let me walk you through that because it's unique. So let's assume for a moment we have an 80% transaction. $400,000 loan, $500,000 purchase price. And let's just assume that the base rate's 575. And the loan officer pitches it to the borrower, and the borrower says, well, I was looking for something for less than 5 in terms of an interest rate. The loan officer comes back to us and says, well, what can we do? We say, well, we can buy it down to 475, but it's going to cost the borrower 2 points. However, those 2 points we will not require the borrower to bring those points in as part of the standard closing costs. Instead, we'll finance those points over and above the 80% LTV. So now all of a sudden, our LTV is really going to be about 81.5%. Okay? The positive to the borrower is he gets the lower interest rate. Yes, he has to pay the 2 points, obviously, but he gets to finance those points over time, and he finances it over and above the 80 LTV, and we don't push him into the next pricing bucket. We just leave him in the 80 pricing bucket. So it's a real positive for the borrower. And in fact, we do the same thing with refis. We don't take it, if it were the same thing and we were doing an 80% refi and the broker asks us the same thing, you'll have to forgive me. Our offices are across the street from the firehouse, and every now and then the firemen like playing with their toys, which is almost every time I get onto a conference call with people. Anyway, so on a refi transaction, it's the same thing. We do a $400,000 loan. The broker comes to us and says, hey, what about a buy down? We say we can do that, and we will do it, and we'll stack the points, which means it won't affect the cash out on the refinance. Instead, the loan will be $408,000. It won't be $400. It's going to be $408, and the borrower's getting the entire $400,000, whether it was cash out or rate term. So it's a real benefit to the borrower, we think. Anyway, that's the answer to that question.
Okay. Someone from American Dream Mortgage asked about borrowers who have done a loan modification to prevent foreclosures.
Well, we certainly do lots of loans to borrowers who have had loan mods in their past. Every one of those are unique in themselves. You know, the questions come to, well, you know, when did the loan mod take place? What does the rest of the credit look like? So I'm not able to answer that question with much more specificity than that, but suffice it to say, I'll just try to give you some bookends. If the guy had a loan mod last month, then we're going to be looking at it this way. We're going to be saying, well, okay, what's the story behind the loan mod? What is the deal that we're doing? It's not likely that we're going to refinance the guy out of a loan mod, because whenever we're doing a refinance, we're going to have to be thinking about borrower benefits. So if he just got a loan mod and he lowered his interest rate, it's probably not real smart to be taking him from a low rate loan into a higher rate loan. But he may be coming to us and saying, hey, I want to purchase, I just got that loan mod on an investment property that I owned and I was underwater on. I still wanted to maintain ownership, and I was able to convince the bank to give me a loan mod. Okay. So then we say, okay, well, what is the purchase price? Is the property he's purchasing, is that going to be owner-occ? And what is the down payment we're looking at? So how much cash is going into the property? So we would consider that if the borrower was putting some real cash down, meaning, you know, like a 25% cash down, and the rest of his credit was good, and his income was there, and it was tight, and we felt good about it. So we wouldn't have any compunction of doing that. That said, if you're coming in and saying, hey, I want the same scenario and I want to do a 90% loan on a purchase, we probably wouldn't do that. Or, hey, I want to do an investment to 80%, we probably wouldn't do that. And then as you get older, as you get more seasoned and the loan mod goes back in time, basically, you know, if it's beyond 4 years, we're not even looking at it. We're not even giving it much consideration at all. And then, you know, if it's a little closer, say within 2 years, we have programs that allow for that as well. So that, you know, it's just a hurdle that needs to be dealt with in terms of the loan structuring that we ultimately get done. Next question.
Great. We have time for one more question, and all the other questions we will address individually. It's from Alliant Financial. They ask about expense factors. Does it depend on the type of business, determined by the expenses coming out of the bank statement, or on a case-by-case basis?
Yeah, well, I tried to explain that a little bit earlier when I gave you the two bookends. So expense factors are all over the place. It is on a case by case basis. I just want you to think about most businesses. You know, if you stop and think about how a business is run, you start realizing that there's probably a lot of different expense structures in a lot of different businesses, and that is very true. And so when you're sitting at our desk and you ask that questionnaire and the borrower comes back to you with their answers, and it's a very interesting kind of learning about their business. And you basically say the kinds of questions that we're asking are kind of P&L oriented, meaning we're asking them what their P&L looks like. Essentially, we're not asking them for a P&L. We're basically saying, hey, do you have cost of goods sold? Yes or no. Do you have a staff? Yes or no. How big is the staff? What's your payroll? Do you have a physical location that you pay for outside the home? You have a factory, 2 factories, 3 factories. What is it that you have? So we're basically asking those things to get a sense for what is it they're really doing. I mean, is it likely that a car dealer is making a 50% profit on the revenue that they sell the car? That would mean you're going to go in and buy a BMW, and the BMW costs $75,000. Is it reasonable to think that dealer is making 50% in profit on that car? That's probably not reasonable at all. It's probably ridiculous. In fact, it is ridiculous. So we wouldn't give a BMW dealer a 50% cost structure as an example. We would use a much higher cost structure, probably up in the 90% range. Okay? So it varies based on the business. That would be my answer to that question.
All right. All right. Well, that's all the time that we have today. I want to thank everyone for joining us today. I will be distributing the copies of the slides to everyone as well as a recording. If you have any other questions or any scenarios, please feel free to reach out to us and we will get back to you very quickly. Thank you so much.
And I would thank you myself. And I would tell you that if you have more questions, you can contact any one of our account executives. I'm sure they can answer all of your questions better than I can. Anyway, thank you. I look forward to meeting you someday. Thanks.
Thank you, everyone.